Tonight I'm going to talk to you about this book here, Investing Quickstart Guide by Ted Snow. I cheated a little bit, so I'm going to give you the table of contents right here so that I don't have to go through each and everything in the book. But I am going through each chapter and I'm giving you an overview of what took place. But other than that, you could follow this. You could pause the screen and you could look into all these things yourself. You wouldn't even have to buy the book if you didn't want to. Although I advise you to read the book, but you don't necessarily have to. You could watch videos on each and every one of these topics. All right, chapter 1, the language of investing. Stocks, common stocks and preferred stocks. There are bonds, treasury bills, or T-bills. And this is a trading symbol, stock price, stock movement, and stock price change. I took this from the book. I took a photo of it. I have a copier, scanner, and all that, but I just don't like using it. It takes so much time. Taking a picture is a lot easier. So this is a price earnings ratio. You could look up all of this stuff. Key stock market indexes like the Dow Jones Industrial Average, the S&P 500, NASDAQ Composite, and the Russell indexes. Then there are bull and bear markets. And a bull market is an up market, a bear market is a down market. In chapter 2, from brokerages to robo-advisors. This chapter will teach you about finding a financial advisor, investment advisors, certified financial planners, internet-based services, robo-advisors. This is a computerized algorithm. And this is a photo of a robot versus human advisor. To be honest, I would rather go with the robo-advisor. It's cheaper, and I can make my own choices. Because if you have a human advisor, they're going to try to advise you to do what they want. And usually what the human advisor wants involves making a profit or even making you look bad. It says here, follow and trade stocks with mobile apps. You can do that too. Chapter 3, how to use time to your advantage. In the world of investing, one of the most treasured assets is time. Index investing and mutual funds. Net asset value NAV, expense ratio, the prospectus, mutual fund load. Then you have ETFs, exchange traded funds, like mutual funds. And like mutual funds, ETFs can be comprised of a variety of different securities and can encompass many investment strategies and goals. This is the creation of an ETF. You can learn all this online too. So, all right. Other investments and funds, money market funds, target date funds, hedge funds, and so forth. The tax factor, interest, dividends, and capital gains, traditional and Roth IRAs. Chapter 4, decision time, deciding when, where, and how to invest. The author mentions the dot-com bubble of the 1990s and the real estate bubble of 2005 through 2007 and the financial collapse of 2008. Any book you read on investing or stocks is always going to mention the dot-com bubble, the real estate bubble, and the financial collapse of 2008. It's just a given. How to choose a stock, ETF, and other security. The author says to invest in a company that you are familiar with. Use stock screeners to search out the right picks. These stock screeners are tools offered by brokerages and other companies that allow investors to filter their view of various stocks. And you have macro level factors for investing, like interest rates. When the U.S. Federal Reserve lowers interest rates, the economy should respond favorably by adding jobs and increasing the circulation of capital. When interest rates are high, investors are more likely to leave their money in the bank. Political stability. Wall Street is apolitical. Well, it's supposed to be at least. Their primary concern is making money. Nervous investors do not invest in stock, but instead lock their money away until conditions stabilize. Employment. High employment rates are a sign that businesses are confident, and low employment is a sign that businesses are not hitting their targets. Taxes. Number 4. The promise of lower taxes boosts the market. Higher taxes can be disquieting for businesses. Now, when Trump was elected president in 2016, the stock market had a bit of a boom because Trump promised to lower taxes. He also promised a lot of other things, and I don't know if he delivered on those. So, number 5, economy. The economy is subject to persistent ebb and flow of business activity known as the business cycle. That's one thing about the economy. It will always ebb and flow. It will always go up and down. There will be peaks and valleys. But every time there's an economic low of some kind, all the doomers and preppers all say we're headed for a collapse. I don't think I believe that, to be honest. The 3 biggest mistakes investors make. Investing too conservatively. We need our investments to grow and keep up with inflation. 2, beginning too late. Your money goes further the earlier you invest it. 3, not investing enough. Your investment contributions should be a fixed expense in your monthly budget. Chapter 5, investment strategies. Your investment strategy should be based on your tolerance for risk, your investment goals, the industries you are familiar with, the time you intend to spend researching investment opportunities, and the amounts and frequencies with which you expect your investments to produce yields. Chapter 6, the short game. This chapter covers day trading, options trading, buying stocks on margin, short selling, penny stocks, forex, and commodities futures. Investors and traders are the 2 major actors in the stock market. There's the typical investor who buys and holds, and there are traders who buy and sell right away. Chapter 7, investment psychology. Good investors don't act on impulse. They act on sound judgment. Let's see here. Net equity inflows versus S&P 500. So you have hope, despondency, depression, optimism. It just keeps on going up and down. Chapter 8, Beyond Profit. There are ethical ETFs. And these are people who want to invest in the environment, or resource efficiency, or equitable society, human rights, and accountable corporate governance. You see, this you can go to. Chapter 9, Investing Your Way to Financial Freedom. Financial freedom is also known as financial independence. It's the ability to generate livable income without having to work. The biggest obstacle to financial freedom is not income so much as spending. To be financially independent in the future, you need to live below your means. There are also investment strategies involving a Roth IRA, or like a 401k. In conclusion, this book is good for anybody who wants to start on their stock market education. And before getting into the world of investing, I strongly advise you to watch a lot of videos and read books like these here. So good luck.